Wall Street just declared war on itself, and silver is the battlefield. Goldman Sachs says, stay away from silver. JP Morgan says silver has a floor and the rally is intact. Same metal, same data, completely opposite conclusions. And these are the largest investment banks on earth with billions at stake and data you and I will never see. So either one of them is catastrophically wrong, or they're just positioning for a different outcome because they know something we don't. Goldman Sachs says gold is going to be above $5,500 by 2026, driven by central banks buying and ETF inflows when Fed cut rates. But on silver, they say volatility is extreme, stay cautious, which in translation means silver is dangerous, avoid it. JP Morgan, they're completely different. They have a completely different statement and take. They say silver has a $75-$80 floor and is unlikely to give up gains. And that in translation means the bottom is in, buy the dip. Bank of America, they are bullish on gold and saying gold would reach above $6,000, but they're worried that the rally is happening way too fast. UBS says high silver prices will destroy industrial demand, so silver could fall. So we have 4 banks, 4 narratives, same data. And this isn't about fundamentals, it's about positioning, clients, and flow. There are a couple of reasons here. Reasons for why we see these different takes on silver and gold. Number 1 is different time frames. Goldman is probably focused on short-term volatility risk. JP Morgan is looking at long-term bull market being intact. Both could be right. Reason 2 is different clients. Goldman clients are pension funds, sovereign wealth, and they hate volatility. JP Morgan clients are hedge funds, family offices, and they love volatility when they're focused on the long term. So they give different advice to different audiences. Reason 3, positioning their own books. And I think this is where the real game is. Banks position first, then release research that drives client flow. Goldman likely doesn't want retail flooding into silver and increasing volatility. JP Morgan likely wants buyers to defend the $75-$80 level because they are long. This isn't conspiracy, this is how markets simply work. And we know that silver crashed in just a couple of days, and that's probably one of the worst crashes, not probably, but that's for sure one of the worst crashes in history. But fundamentals didn't actually change. Industrial demand for solar, electric vehicles, AI is still strong. Supply deficit still exists. China exports controls still in place. And this looks like it's a technical leverage flush, not a fundamental collapse. The physical market, which is the real truth, is still intact. Silver lease rates at 6.1% versus the normal between 1 and 3%, which is showing panic and tightness. COMEX registered inventory is falling, and we have massive open interest versus available supply. Premiums are 15-20% above spot. China votes draining. So physical market says shortage, but paper market says volatility. Now, when it comes to comparing gold versus silver, because I know a lot of people are coming and asking me this question, the only thing that all the banks right now agree on, there is only one thing that they all agree on, and that is gold is going higher. That's the one thing everyone agrees on. Gold is going higher. Goldman target is $5,400. JP Morgan is betting on $6,300. We have other banks that are aiming for $6,000 per ounce. The consensus is that the gold bull run continues, but silver is the wild card. Gold will continue steadily climbing, but silver is kind of a roller coaster. And if you're not sure what to do, if you want to play it safe, probably gold is your assets, 20-30% gains, low volatility, predictable. If you're aggressive and long term, silver is leverage on gold. It could go 100% up, 200% up, or it can crash 50% again. So position size matters more than price targets. Don't go all in, just base your entries on probabilities. Because as we can see, silver is volatile. If you want less upside but something more secure, then gold is your asset. So there are 3 scenarios that I want to share with you here. If Goldman Sachs is right, let's say silver chops sideways, gold slowly rises. Gold wins, silver underperforms, if we follow what Goldman says. Scenario 2, JP Morgan is right. We see physical squeeze. Silver is going to $100, $150, $200 and above. Gold rises, but silver massively outperforms in 2026. And scenario 3 is if everyone is wrong, meaning that rates stay high, demand collapses, gold goes down to $4,000, silver goes back down to $50, and cash wins, which I think this is sort of the most unlikely scenario. My take is mainly what JP Morgan says, that we would see silver going up this year and still outperforming gold purely because of the industrial demand for it. But again, long term, I personally think that gold is a safer bet. Gold is consensus bullish. Everyone agrees on that. Silver is asymmetric, volatile, and potentially explosive. The banks aren't arguing fundamentals. They are managing flow, clients, and their own books at the end of the day. So we could see silver panning out in different direction. My take is that if you can hold the physical silver, that is much better, and whatever price you buy it in, long term, you would be okay. Short term, you might see silver being volatile. And if you're holding digital silver, this is where you are not too safe. So I would kind of advise you to stay cautious a little bit and maybe bet on, if you're going to go digital, maybe bet on gold. If you're going to go physical, you can have both of those assets. Now let me know in the comments below, are you holding silver or you're betting on gold for 2026? That's from me today. Thanks so much for watching. I'll see you in the next video.